Hello students and welcome to the lecture. So students, as we know that we are covering the financial knowledge and the banking awareness part of it. And basically right now, since the previous few lectures, we had started the discussion over banking reforms and mergers. All right. And we had discussed the banking reforms which had been taking places over the period of time due to the requirement of time and changes in the economy. Also, we had covered the banking mergers. Okay, like what do you mean by the merger? Okay, what do you mean by the acquisition? What is the meaning of subsidiaries? What is the difference between the consolidation and the merger? So we had completed these topics so far, right? Okay, so basically in this lecture we are going to continue the same topic. It means the banking reforms and mergers, but right now we are going to do two things. Okay, we are going to compile up all the information or all the info we have covered. Okay, means what we have covered in the banking reforms, what we have covered in the banking mergers, we are going to compile them as together so that we can have a quick revision. All right. And second, that we are going to cover the banks which were get merged over time. All right. So these are the two new things we are going to cover in this lecture. First, we will compile all the information we have covered so far for a quick revision and the compilation. Second thing is that we are going to cover the banks which were merged over the time and which are important from the examination point of view. All right. So basically, we are going to cover the more details on the banking reforms and mergers. So far, what we had covered is the banking reforms and the banking mergers. Now we are going to explore the more knowledge over them. All right. So this is what we are going to cover. Start. First is the a need for the banking merger and the reforms. The need for mergers in India's banking sector is driven by various factors that aim to improve the efficiency, stability, and competitiveness of bank. All right. As we had discussed in the previous lectures, that the mergers are oftenly done for various kind of things. Okay. For capturing of the market, for fulfilling the mutual needs, also for the stability. Right. So that's why they are aimed to get merged for the efficiency, stability, and the competitiveness of bank. Okay. Understanding the need for merger is crucial for competitive exam as questions related to banking reforms and consolidation in the financial sectors are commonly asked. So, first need, what we are going to cover is the first need, enhancing financial strength. Mergers strengthen the financial position of banks by consolidating weaker ones with the stronger ones. This pooling of resources and capital improves their ability to absorb losses and navigate economic challenges. Okay, I'm going to repeat the example which we had covered in the previous lecture also, so that we can have a proper compilation. Okay, suppose we have a bank A which is a larger bank. All right, this bank needs a 20 branches or 20 new branches, right? Thereafter, we have bank B, which is a smaller bank. Okay, and they having the NPA of rupees 40 lakhs. Okay, this is their current scenario. All right, but if we talk about the benefits which we will have after merging the bank A and the bank B, so we can say that the bank A basically having the additional 40 lakhs as a reserve. Okay, and similarly bank B having 20 branches as required by the bank A. Okay, so when the bank A and the bank B will get merged, and we will have a new entity which we call the bank C. All right, so the bank C will cover up this loss of the NPA of bank B, whereas bank C also get the 20 branches for the need of bank A. All right, that's how their stability will be strengthened. Okay, so most of you will ask me, financial strengthen will be applicable for bank B only, right? But what is the benefit of bank A? The bank A gets the 20 branches. And remember, when the bank is going to open a new branch, they have to invest the capital, they have to acquire a land, they have to put the labor on force, they have to build a physical infrastructure. Secondly, they have to pay various fees, they have to go through various procedures. So it's not only a time-taking process, but also a physically enabled process. Sorry, financially enabled process. Okay, that's why the merger is beneficial for both the bank A and the bank B. Okay, so first thing is the enhancing financial strength. Okay, the merged entity becomes more financially robust, increasing its reliance and reducing the risk of financial instability. Okay, as we had covered, not only the need of rupees 40 lakhs to counter NPA was fulfilled, but also the new bank got 20 branches. It means they have got the customer base of more 20 branches, and also they had got themselves introduced in the 20 branches. All right. So that's why right now the bank C, which will be formed after merging of bank A and bank B, is not only stable from the NPA point of view, but also stable from the consumer base point of view. Okay. Secondly is the addressing NPAs, as we had discussed in the previous lecture. Okay. Banks burdened with a high volume of NPAs often suffer from a reduced profitability and the financial health, as we have the example of the bank B, which is having the NPA of rupees 40 lakhs. Okay, so whatsoever revenue and the profit receiving by the bank B, the bank B is investing that particular ratio in the reserve to counter this NPA loss. Okay, because the amount belong to the depositor and the stakeholders. Okay, and this amount has to be released as obligatory on the bank B. All right, so that's why the bank B has to put their interest, put their profit, their revenue, all the things in the reserve to compile up rupees 40 lakhs to discharge this duty. Okay, this reduces the growth chances of bank B, because instead of investing their money into their growth, they have to investing their money for gathering rupees 40 lakhs. All right. Mergers can facilitate the resolution of NPAs by leveraging the expertise and the resources of stronger banks. In case we have the bank A, when the bank A will get merged with the bank B, the bank A will pay those 40 lakhs so that the revenue bank B were earning from the customers could be utilized for their growth. Okay, the combined entity can take effective measures to rehabilitate or recover these bad loans. All right. Thereafter, rationalizing branch network. Mergers lead to the streamlining of operations and the rationalization of branch networks. Overlapping branches can be merged or closed to eliminate duplication and reduce operational cost. As we had taken the example of the 100 customers which were divided into the bank A and the bank B. Okay, so that's why both the bank A and bank B getting the segmented or getting the scarcity of the customers, basically not segmented, but the scarcity of the customers they are getting. Okay, due to this, they have to bear the losses as their operational cost is continuously spending. Okay, but when they get merged and the single entity was formed, which will known as the bank C. Okay, so these 100 customer instead of getting divided between the bank A and bank B, are directly reaching by the bank C. It means that the new entity will have a entire customer base, okay, which will strengthen the rationalization of the branches, right? That's what we had discussed. This optimization enhances the cost efficiency of the banking network and enables the redeployment of resources to areas with more significant potential growth. Okay. Fourth is the improving corporate governance. Merged entities can benefit from enhanced corporate governance practices and risk management frameworks. As we had discussed in the previous lecture, suppose we have the bank B or bank A. Okay, bank A we have. Bank A basically having a resources like they having a good financial team. Okay, they having a good management team. All right, they having a good legal team. Okay, they having good sales team. All right, similarly we having the bank B. Okay, so bank B having a good marketing team. Okay, bank B having good technical team. Okay, they having good you can say customer support team. All right, and secondly they having you can say good storehousing team or storekeeping team, you can say they having good storekeeping team. All right, so these are the teams, but when they will combine together and form the new bank which will be known as the bank C. So the bank C will having all the teams, means the financial team, management team, legal team, sales team, marketing team, technical team, customer storekeeping team. Sorry, storekeeping team, not customer support, but the storekeeping team. So they will have the combination of all these teams, and totally we can say they having the entire marketing team, all right, financial team, all right, legal team, all right, sales team, okay, storekeeping, okay, customer support, all right, and the remaining tools were management and technical. Management and technical. So by comparing the previously situation, means the bank A and the bank B when they were separate. So do you think that they were as capable as the bank C will be after the merger? No, because the bank C will having the robust 8 teams, whereas bank A only having the 4 teams and the bank B itself having only the 4 teams. Okay, so that's why we say that banking mergers often leads to the improving corporate governance. Okay, and when the bank C will be formed out after the merger, so all the stakeholders and the shareholders or the customers, you can say, who were already existed with the bank A and the bank B will get confidence in the bank C, because they can see the combination of all the teams, so that they can trust on the futuristic action. Okay, even the new stakeholders or shareholders or the customers will attract towards the bank C, because they will get to know that the bank C having a robust 8 team solution, which will give them the upper edge in the competition, and also the customer or the shareholders who are using the services or are involving in the operations by some of the way will get a benefit of it. All right. Thereafter, stronger governance structures are often implemented to ensure the transparent and complement banking operations, promoting trust among stakeholders and enhancing the bank's reputation. Achieving economies of scale. Mergers create large entities with a broader customer base, leading to the economies of scale and operational efficiency. Okay. So basically, if we talk about the economies of scale, so we have a detailed lecture on it in the upcoming lectures. Till then, just let me tell you an overview. Basically, economics of scale refers to the growth or spreading of the business. All right, this is the meaning of economic scale. Okay, but we will have a discussion over it in the upcoming lectures so that I can explain you in the proper form. Okay, so if we go by the example, then we having two banks, the bank A and the bank B. Bank A and the bank B. Bank A having the 30 branches. Okay, bank B having the 20 branches. All right, bank A having the rupees 500 crores. Bank B having rupees 700 crores. Okay, so when they get merged, we had got the bank C. All right, so technically, bank C will have 50 branches and the reserve of 1200 crores. Rupees 1200 crores. Okay, that was I was telling you. All right, so we can say merger often leads to the growth of the business or the economies of scale, because now the bank C will have the huge base of 50 branches and the huge capital of 1200 crores. Okay, this will leads to the operational efficiency enhancement. Larger banks can offer more extensive range of products and services, benefiting customers and expanding business opportunities. All right, because they have a wide network of the 50 branches, it means that they will earn a more and more customer base. Second, they having the reserve of rupees 1200 crores, which would be invested by them in their services. Okay, so that their services would be increased or enhanced and the customer will be attracted to them. Thereafter, strengthening the capital base. Mergers may result in the fusion of the capital into the weaker banks by the stronger ones. This capital injection improves the capital adequacy ratio of the merged entity. All right, suppose we having the one bank which having the capital of rupees 1000 crores. Okay, we having the bank B which having the reserve only for rupees 600 crores. Okay, so when they get merged and the new bank will be formed, which will be known as a bank C. So the total reserve will be 600 crores. Okay, it means both of their capital got infused, and the bank B, which was the weaker bank, now having the huge capital base of 600 crores. All right. A stronger capital base enhances the financial stability of the bank and its ability to meet the regulatory requirements. All right, because when they have the rupees 600 crores with them, so they're not only able to invest it into the various scenarios, but they are also able to maintain the healthy CRR and the SLR ratio, and also are able to fulfill their obligatories towards the priority sector lendings. Okay. Seventh is the facilitating technology adaptation. Merged banks can leverage each other's technology infrastructure and expertise, accelerating the adoption of advanced banking technology. Okay, suppose bank A, they having a good technology called technology A or technology XYZ, you can say. Okay, whereas we have the bank B. Okay. Bank B having the technology called DEF. All right. So when both the banks get merged and the new bank called Bank C was formed. Okay. So the Bank C having the both technologies, technology XYZ plus technology DEF. Okay. So the Bank C will have the advantage of both the technologies and ultimately will get the benefit of it during the market during the market exploration, you can say. Okay. The incorporation of modern technologies enhances customer services, streamline operations, and the foster innovation. Okay. Thereafter, we have the enhancing competitiveness. Merged banks are better equipped to compete effectively in the market, both domestically and internationally. They can leverage their combined strengths to offer a wider range of services and compete with other financial institutions. Because not only their consumer base get merged, their capital get merged, but also they get a technological advancement, which will give them the upper edge in the international and the domestic competition. Okay. Thereafter, promoting the financial inclusion. Mergers can aid in expanding banking services to the unbanked and the underbanked areas, contributing to the financial inclusion. The broader reach of the merged entities ensure that the banking services are extended to regions and populations that were previously undeserved. For example, suppose we have the bank A, we have the bank B. Okay, bank A having the capital base of rupees 500 crores. We having the bank B with a capital base of rupees 100 crores. Both the banks were operating in the different regions. Okay. Bank A mostly having their branches in the urban areas. Alright. Whereas Bank B having mostly of their branches in the rural areas. Alright. But Bank B is not able to fulfill the needs of the rural areas people due to the shortage of capital. They're having the capital shortage. So that's why they are not able to meet the demand of the rural areas people. Okay. Similarly, now the bank A. The bank A is want to open the branches in the rural areas. Okay. So for this, they had make a deal with the bank B that they both will establish a new bank called the bank C after get merger. Okay. So if we assume the scenario, so the bank C will have the branches in the rural areas. Okay. Secondly, bank B will having the capital of rupees 600 crores. All right. It means that they would be able to promote the financial inclusion because not only they have got the number of branches in the areas, but also they had got the capital to which they were shortage. All right. So this is the benefit of the financial inclusion. These advantages reflect how bank mergers can lead to more efficient, stable, and the competitive financial institutions, ultimately benefiting customers, shareholders, and the broader economy. However, it's crucial for mergers to be executed carefully and managed effectively to realize these benefits fully. Okay. The need of mergers in India's banking sector is part of the broader banking reforms to strengthen the financial system and improve the overall health of the economy. Mergers are a strategic tool used by the government and the Reserve Bank of India to create robust and the efficient banking entities that can effectively contribute to the growth and development of the Indian economy. All right. So students, here we have finished the part 1. The part 1 was compilation of the already covered info. Right? We had covered the part 1. Okay. So let's start the part B. So the part B we have is the discussion over the banks that have undergone the mergers. Okay. In India, several banks have undergone mergers over the years to consolidate their operations, improve efficiency, and strengthen the banking sector. Okay, so what are these banks? Let's have a look. The first is the State Bank of India and its associate banks in the year of 2017. Okay, but if we are talking about the State Bank of India, so I think that we must revise the some facts and figures which we had covered in before this lecture. Okay, so basically, if we talk about the first modern bank in India, which was established, what was the name of that bank? So the bank was named as the Bank of Hindustan. And what was the year? 1770. So the Bank of Hindustan, which was the first bank or the first modernized bank, was established in India, was named as the Bank of Hindustan. All right. Thereafter, we have the second bank, which was named as the General Bank of India. Okay, which was established after the Bank of Hindustan. All right, but what was the significance of these banks? They had started the overall journey of the modern banks, but unfortunately, they were closed down after some years. They won't be able to sustain themselves in the Indian market because on that time we do not have a concept of monetary economy in the full fledged. We do not have this kind of concept. All right. So because of this, they do not get a initiate. They do not get a for this. They do not get a sufficient capital support so that they could continue for a long. All right. That's why they got closed down after some years. Okay. Then we have seen that we had got the what British interference, or we can call it the British government interference. Okay. And thereafter, we have seen that we have three banks established back to back. The first was the Bank of Bengal. Second was the Bank of Bombay. And third was the Bank of Madras. Okay. So what was their establishing year? The first Bank of Bombay was established in the year of 1840. Okay. The second, not 1814, 1806. Okay. Second bank was established in 1840 and the third bank was established in 1843. All right. So these banks were established by the Britishers. All right. Thereafter, we have seen there is a Act of 1871. The act was named as Presidency's Bank Act. Okay, this act was merge the management of all the Presidency's banks. All right, so all these areas where these banks were established, these all were the British presidencies. Okay, because of these, they were called as the Presidency's banks. And in the year of 1871, the Presidency's Bank Act was passed and all these banks get merged. All right. Thereafter, we have the new year, which was named as the 1921. What happened in 1921? In 1921, Imperial Bank Act was passed by the Britishers. Okay, which leads to the merger of all the three Presidency's banks. Okay, So in the year of 1871, their management get merged. But in the year of 1921, all the resources they had get merged over the time. Okay. So this is the general introduction to the topic of the merger of the SBI. And also these are the topics which we had already covered, and it is a little bit revision about them. All right. So now let's go back. Okay. So now we have revised that from where the journey of the merger with the SBI was started, from the establishment of the Presidency's banks, then the Presidency Act passage year, and then the 1921. Okay. But the one thing which we had missed here is the another important year which was named as the 1955. So now it's a question from my side to you. What was happened in the 1955? You have 10 seconds to answer. Your time starts now. It's 1, it's 2, it's 3, it's 4, it's 5, it's 6, it's 7, it's 8, it's 9, it's 10, over. So in 1955, there was a State Bank of India Act was passed. Okay. And by the passage of this act, Imperial Bank was nationalized. Okay. Which was established by the British government in the 1921. All right. So the prior to merger, SBI had several associate banks, including the State Bank of Bikaner and Jaipur, State Bank of Hyderabad, State Bank of Mysore, State Bank of Patiala, and the State Bank of Travancore. So remember these banks. First bank is the State Bank of Bikaner and Jaipur. It is the first bank. Second bank was State Bank of Hyderabad. All right. Third bank was State Bank of Travancore. Fourth was State Bank of Mysore, right? Sorry, State Bank of Travancore it is. Travancore. Okay. Thereafter, we have the State Bank of Mysore, and the fifth we have the State Bank of Patiala. Okay. So these were the 5 banks which were working as an associate of the State Bank of India prior to the year of 2017. Okay. So this is the background. These banks were functioning as separate entities but were part of the SBI group. All right. So if we talk about the rationally, means what was the reason given behind this merger? The merger aimed to eliminate the operational redundancies, improve efficiency, and leverage the strengths of the associate banks. Okay. Because, however, they are working independently, but still they are the part of the SBI group. Okay. It means that the operational cost bearing by them and the cost appearing on the State Bank of India are the same. Okay. So why they have to pay the separate costs for the same thing? All right. So you can say this merger leads them to eliminate the operational redundancies. Okay. And because of this, their efficiency would be improved. And that's why they get the strength to build together. Okay. Key outcomes. The merger resulted in the consolidation of these associate banks into the State Bank of India, making it one of the largest and most influential banks in India. Okay. For example, we can say, suppose SBI already having the 100 branches. Okay. So, State Bank of Hyderabad. Thereafter, State Bank of Mysore. Okay. State Bank of Patiala. State Bank of Travancore. And then we have a State Bank of Bikaner and Jaipur. Okay. So these banks were working independently in their areas. So suppose SB having 50 branches. Okay. Mysore having 20 branches. Patiala having 40 branches. Travancore having 30 branches. And Jaipur and Bikaner having 10 branches. It's just an example. Okay. So when these banks get merged with the State Bank of India, it means their branches will also get merged. So if we try to find out how many branches will be received by the State Bank of India. So 50 and 40, 90, 19, 20, 1110, 1110, 30, 140, 140, 10, 150. It means total new 150 branches will be received by the State Bank of India, which already having the 100 branches. And if they get 150 additional branches, so the total branches number now will be 250 branches. Alright, now you can see how much customer base will be received by the State Bank of India. Okay, so the similar thing was happened, and the SBI becomes the largest and the influential banks in India because now they have a huge customer base. Benefits: improved financial strength, greater efficiency, expanded reach, and enhanced market presence. Second merger, we have the Bank of Baroda, Dena Bank, and the Vijaya Bank in the year of 2019. Okay, so student, there are two main things which we require to study. The first thing is that we have to remember the name of the banks which get merged together. Alright. So suppose if the question asks that in the year of 2019, which three banks will get merged? The options are BOB, the Bank of Baroda, Vijaya Bank, and the Union Bank. Okay. So if you do not have the clarity and you do not revise the facts, then you will mark this as a correct. Okay, because you know that three banks will get merged. But what was the name of that banks? We don't know. Okay, so in this scenario, the correct answer should be the Bank of Baroda, the Dana Bank, and the Vijaya Bank. Okay, it is the first thing. Remember the name of the banks. Second is remember the year. In which year it was happened. Okay, if the option is that the State Bank of India get merged with the 5 associate banks of it in the year of 2019. Is this true? So if you are not aware or you haven't revised the facts, that you will say, yes sir, it was true. But it was wrong. Because that year was not the 2019, was the year of 2017. Got it? So please remember these things. Alright. So if we talk about the background, so the Bank of Baroda was one of the India's largest banks, while Dena Bank and the Vijaya Bank were the small public sector banks. Okay, so in this scenario, we can say Bank of Baroda is the larger one, whereas the other two means the Vijaya Bank and the Dena Bank. These two were the smaller bank. Okay, so here we can say there is a condition of larger bank absorbing the weaker bank. Got it? All right. Now we have the rationally. Okay, the merger aimed to combine the operations of three banks to create a stronger and the more competitive financial institution. Key outcomes: the merger resulted in the consolidation of the Dena Bank and the Vijaya Bank into the Bank of Baroda, in which the Bank of Baroda was the larger bank, right? And the other two were the smaller bank. Benefits: wider geographic reach, economies of scale, and enhance the financial strength. Okay. Thereafter, third we have is the Oriental Bank of Commerce and the United Bank of India with the Punjab National Bank, 2020. Okay. If we talk about the background, then Oriental Bank of Commerce and the United Bank of India were two public sector banks in India. Okay. Punjab National Bank is a public sector bank or a private sector bank? Can you tell me? It's a public sector bank. Okay. And it was a part of these banks which get nationalized in the 1969. Okay. Punjab National Bank was one amongst them. Got it? So if we talk about the rationality, then the merger aimed to combine these two banks with the Punjab National Bank, one of the India's leading public sector banks. Okay. So here also the PNB, also known as the Punjab National Banks, was the largest bank. Okay. Whereas the other two banks, means the Union Bank of India, okay, and the another one was Oriental Bank of Commerce, was Oriental Bank of Commerce. Okay, these two were the smaller banks. Got it? So remember this thing. All right. Question may be asked in a scenario like in the year of this, these two banks were get merged with the Punjab National Bank. Which of the following is correct? And might be the option will be like this. Union Bank of India and the Oriental Bank of Commerce were the largest bank, while the PNB was the smallest bank. So the PNB got the benefit of it. All right. Is this statement true or wrong? The statement is true, right? No, the statement is wrong. Why? Because the Punjab National Bank is the leading public sector banks, whereas the Union Bank of India and the Oriental Bank of Commerce having the limited presence. All right. So in such a scenario, the statement in the correct form will be that the Punjab National Bank is the largest bank, whereas the Union Bank of India and the Oriental Bank of Commerce were the smallest bank. All right. Thereafter, if we talk about the key outcomes, the merger resulted in the consolidation of the OBC. OBC here is referred as a Oriental Bank of Commerce, and the UBI, which is referred as a Union Bank of India, into the PNB, which is referred as a Punjab National Bank. Okay, making it the second largest public sector bank in India. Because as the State Bank of India gets the benefit from merger, these Punjab National Bank also get a benefit from the merger. All right. If we talk about the benefits, that the strengthened position, because now they had got the position of second largest PSU or the public sector undertaking. Public sector undertaking. Okay. Thereafter, enhance the geographic reach. Third is economies of scale. And the fourth is improved financial stability. Okay. Thereafter, we have the fourth one is the syndicate bank with the Canara Bank. Year was 2020. Okay. Background. Syndicate Bank was one of the public sector banks in India, and the Canara Bank was another well-established public sector bank. Okay. If we talk about the rationality, then these merger aim to consolidate the operations of syndicate banks into the Canara Bank. All right. Key outcomes. The merger resulted in the consolidation of syndicate banks into Canara banks, making it one of the largest public sector banks in India. All right. So we can say the syndicate having its presence the Canada having its presence. But when they get merged, they becomes the one of the largest, not the largest, remember, one of the largest PSU in India. All right. Benefits: enhance the geographic reach, improve the economies of scale, and improve the financial strength. All right. Thereafter, we have the Indian Bank with the Allahabad Bank in the year of 2020. Okay. Background: Indian Bank and the Allahabad Bank were two public sector banks in India. Okay. Here is one thing which I would like to remind you. Already I had told you in the previous lectures that the Allahabad Bank was established by the group of Europeans. In the topic of banking history, we had discussed it. Okay. So do not mark it as a bank established by the Indians. It was established by the Europeans. Okay. So if we talk about the background, then there were two public sector banks in India. Rationality: the merger aimed to combine the operations of these two banks. Key outcomes: the merger resulted in the consolidation of Bank of Allahabad into the Indian Bank, creating a more extensive public sector bank in India. If we talk about the benefits: enhance the geographic reach, economies of scale, and improve the financial strength. Thereafter, we have the Union Bank of India, Andhra Bank, and the Corporation Bank in the year of 2020. Okay. Union Bank of India was one of the largest public sector banks in India, while Andhra Bank and the Corporations Bank were other two public sector banks. The merger aimed to consolidate the operations of these banks under the Union Bank of India. Key outcomes: the merger resulted in the consolidation of Andhra Bank and the Corporation Bank into the UBI. Alright, so remember, however, the UBI get merged with the PNB. Okay, but the Andhra Bank and the Corporation Bank were also get merged into the UBI. All right. So we can make a flow chart like this: Andhra Bank, Corporation Bank. Okay. These two banks get merged into the Union Bank of India. All right. Which was get later merged into the Punjab National Bank. Okay. So remember this thing: benefits: enhance geographic reach, economies of scale, and improve financial strength. Okay. So if we make out the conclusion of all these details we have discussed, these mergers were part of the government efforts to strengthen the banking sector, improve governance, and enhance the overall financial health of the public sector banks. The consolidation entities are expected to provide better services, increase operational efficiency, and contribute more effectively to the country's economic growth. Candidates preparing for competitive exams should be aware of these mergers and their implications on the banking landscape, because you are going to be the part of that particular industry if you are aiming the competitive exams in that field. So that's why you are not only required these knowledge to crack the exam, but also for other kind of things which you will be having after getting a selection. Okay. So students, basically we have finished the series of banking reforms and mergers under the banking awareness or under the financial knowledge. Okay. In the next lecture, we will start with another thing. Till then, just revise all the facts and figures we have discussed in this lecture and be ready for the another lecture. With this note, let's end this lecture and thank you.